They crashed silver, and most of you are looking at the wrong people. I have spent more than 4 decades studying commodity markets. I have watched gold, oil, copper, wheat. I have watched them all get squeezed, manipulated, reset, and repriced. And I will tell you right now, with absolute certainty, that what happened to silver in January 2026 is the most important and the most misunderstood episode in the silver market since the Hunt brothers tried to corner it in 1980. Silver rose 150% in 2025, its best calendar year performance in over 4 decades. It broke above $100 per ounce for the first time in recorded history. It touched $121 in January 2026, and then, in 14 days, it crashed 46% to $64. 46% in 14 days. Most of you heard that number and immediately reached for an explanation. And the internet was very generous with explanations. The banks did it. The government did it. The shadowy cabal of short sellers did it. Some of those explanations contain partial truth. But partial truth in markets is more dangerous than a complete lie, because partial truth makes you confident when you should be careful. I am going to tell you the complete truth. The truth about what actually crashed silver, what the numbers really mean, and what I believe is most likely to happen from here. I call this the paper promise trap, and by the end of this, you will understand why the most dangerous place in the silver market is not where the metal is most scarce. It is where the confidence is most misplaced. Let me begin with what actually happened, because the sequence of events matters more than most people realize. In the first week of January 2026, something extraordinary occurred inside the COMEX exchange. 33 to 45 million ounces of silver were physically withdrawn for delivery in a single week. That represents approximately 26% of the registered inventory, disappearing in 7 days. Lease rates, the rate at which large institutions borrow physical silver, had exploded from a historical norm of 0.3 to 0.5%, all the way to 8%. Backwardation, the condition where silver for immediate delivery is priced higher than silver for future delivery, was signaling the kind of urgent, desperate physical demand that markets almost never see. On the surface, this looked like the squeeze that every silver bull had been predicting for years. And then the exchange acted. On January 7, 2026, the CME Group raised silver maintenance margins to $32,500 per contract. Then again on January 30th, moving margin parameters from 11% to 15%. The effect was immediate. Leveraged traders who had been long silver, betting on prices to continue rising, suddenly faced margin calls they could not meet. They had no choice but to sell. Forced selling created more forced selling. Algorithms accelerated the cascade, and in 48 hours, months of gains were gone. This is what I call the margin escalation mechanism, and it is the single most important concept for understanding this market. It is not new. It is not secret. It is in the rule book. I watched the CME and its predecessors deploy this exact tool 5 times in 8 days against silver in 2011. I watched it deployed against the Hunt brothers in 1980, when the exchange made silver contracts liquidation only, meaning no new long positions could be opened, only existing ones closed. The Hunt brothers' operation collapsed immediately. Understanding this mechanism changes everything about how you should be positioned in silver, and I will come back to that. But first, I want to address the myths, because they are everywhere, and some of them are costing real people real money right now. The first myth you are hearing is that COMEX only has 70 million ounces of registered silver left and is about to default. Here is what is true, and here is what is being deliberately omitted. COMEX has 2 categories of silver inventory: registered silver, bars that are actively offered for delivery, and eligible silver, bars sitting in approved vaults owned by investors and institutions, not currently available for delivery, but convertible to registered status in a matter of hours, with nothing more than a few keystrokes. As of early February 2026, registered silver stood at approximately 103 to 113 million ounces, according to exchange warehouse reports. That number is declining. The decline is real and significant. But what is being omitted is that eligible silver sitting in those same vaults adds several hundred million additional ounces. Does the dramatic decline in registered silver matter? Absolutely. It tells me that physical demand for immediate delivery is at historically elevated levels. It tells me the system is under genuine stress. But stress and collapse are different things, and treating a stressed but functioning system as already broken leads to decisions that destroy the investor who makes them. The second myth is the 350 to 1 paper to physical ratio. This is the number I hear most often, and I understand why it sounds alarming, but it is mathematically wrong in the way it is being calculated. The 350 to 1 figure comes from taking the notional value of every silver derivative, futures contracts, options contracts, swap contracts, and dividing it by the physical silver in COMEX vaults. Let me give you an analogy I use when explaining leverage to institutional investors. Imagine you own a house worth $500,000. You have a mortgage. Your neighbor has homeowner's insurance. An investment bank has a derivative linked to your neighborhood's property values. A hedge fund holds a position in a real estate index that includes your street. If you add up all those contracts, you might reach $3 million in financial instruments linked to your single house. Does that mean your house is leveraged 6 to 1? Does it mean 6 people are going to show up demanding a room? Of course not. Most of those contracts settle in cash. Nobody asks for the house. The same logic applies to silver futures. Most contracts are closed before delivery. Most options expire worthless. Most swaps settle in dollars. The actual ratio of paper claims that could credibly demand physical delivery is closer to 7 to 1. That is elevated relative to the historical norm of 3 to 4. That is real stress worth monitoring carefully, but it is not 350 to 1, and presenting it as such misleads investors into overconfidence about a squeeze that may or may not materialize on the timeline they expect. Now let me tell you the part of this story that almost nobody is talking about, the part I find most structurally significant. In January 2026, a financial crisis erupted in the heart of the global silver trade in Rajkot, India. 44 silver trading firms officially declared insolvency, with combined liabilities close to $425 million. These were not reckless gamblers in the obvious sense. These were established trading firms who held paper silver positions, futures contracts, derivatives, paper promises. They believed that paper silver would behave like physical silver. When the CME raised margins and forced the Western leveraged longs to liquidate simultaneously, these firms were caught on the wrong side of the cascade. They held paper bets, not bars. When the exchange moved the goalposts, they were wiped out in hours. And simultaneously, this is the detail that most Western commentators missed entirely. A billionaire Chinese trader had reportedly built the largest net short position in silver on the Shanghai Futures Exchange. A single massive short position was adding downward pressure to global silver prices from Asia at the exact moment Western margin calls were forcing liquidation. The silver crash was not a single event with a single cause. It was a convergence. Leveraged retail longs in the West, a massive institutional short in Shanghai, and margin escalation by COMEX that forced the Western longs to liquidate at precisely the moment Asian selling was at its peak. That convergence produced a 46% decline in 2 weeks, and it left the structural case for silver, the industrial demand, the supply deficit, the de-dollarization buying, the lease rate pressure, entirely intact. I call this the convergence crash, and understanding it is what separates the investors who survive these moments from the investors who get destroyed by them. I want to tell you about one more piece of evidence that the paper market and the physical market are telling completely different stories right now. Samsung, one of the largest electronics manufacturers in the world, recently secured an exclusive right to purchase 100% of the output from a silver mine in Mexico for 2 years. A direct offtake deal that bypassed COMEX entirely. Samsung did not go to the exchange to buy paper futures. They locked up physical mine supply directly because they assessed that the paper market could not reliably deliver the metal their industrial processes require. That assessment has not changed because of what happened in January. And China's reclassification of silver as a strategic material, restricting exports, treating it the way rare earths have been treated, is not a temporary policy. It is a strategic decision reflecting Beijing's assessment of silver's role in its industrial and military supply chain for the next decade. That decision does not reverse when the paper price falls 46%. Shanghai physical silver premiums over COMEX paper prices have been sitting at $8 per ounce or more. The physical market in Asia is pricing in a reality that Western paper markets are refusing to acknowledge. In my experience, that divergence always closes, and historically it closes toward the physical price, not away from it. Now, I want to give you my honest assessment of where silver goes from here, and I want to be honest about uncertainty in a way that most people talking about silver are not. I do not believe COMEX defaults. I assign that scenario a 5% probability. The exchange has too many tools: margin hikes, position limits, cash settlement, rule changes, trading halts, and too much institutional incentive to prevent that outcome. The scenario I consider most likely, roughly 40% probability, is what I call the managed squeeze. Physical markets tighten further. COMEX uses cash settlement and margin tools to maintain order. Prices overshoot toward $100 to $130, correct sharply to a new higher base. If you are positioned correctly in this scenario, unleveraged, in physical metal or high-quality unleveraged ETFs, you benefit. If you are leveraged, the margin call arrives before the payoff does. The second most likely scenario, roughly 35 to 40% probability, is gradual repricing. Silver trades between $70 and $100, grinding higher over months and years as the structural supply deficit absorbs available inventory, as solar, electric vehicles, artificial intelligence infrastructure, and defense demand grows, and as central banks begin adding silver to reserve portfolios. This scenario is less dramatic. It is more likely to produce sustainable, compounding gains for patient investors. And then there is the deflationary shock scenario, 10 to 15% probability, where a recession hits, credit tightens, risk assets sell broadly, and silver, which is 60% an industrial metal, falls below $60 in the liquidation. This is the scenario that destroys leveraged investors. It is also the scenario that creates extraordinary opportunities for investors who hold physical, without leverage, and have cash ready to deploy at the bottom. The common thread across three of those four scenarios is identical: patient, unleveraged exposure to physical silver or high-quality unleveraged ETFs outperforms leveraged paper positions in every case except a full COMEX collapse, which I rate at 5%. That is the investment conclusion hidden behind all the noise. Your instrument matters as much as your thesis. The investors who held physical silver through the 46% crash and are now sitting at $86 per ounce are in a completely different position than the investors who were liquidated on margin at 64. Same thesis, same directional call, completely different outcomes. The difference was not intelligence, it was not research, it was instrument selection and time horizon. I want to end with something I have been saying for my entire career because it applies here more than almost anywhere else in the current market landscape. The comfortable story is dangerous. The comfortable silver story right now is that banks are manipulating everything, COMEX is about to implode, and paper silver will eventually be proven worthless when the physical squeeze arrives and destroys the system. Pieces of that story are true. J.P. Morgan's precious metals desk was the subject of major enforcement actions for conduct the CFTC confirmed was real. The banks do not have clean hands. But knowing that does not make leveraged paper silver a safe investment. The mechanism that crashed silver from $121 to $64 in 2 weeks is legal. It is disclosed. It is in the exchange rules. It does not require a conspiracy. It requires a crowded trade, a leveraged instrument, and an exchange willing to raise the cost of holding that instrument until the weakest hands have no choice but to sell. That mechanism will be used again, not because of malice, because of math. And because of math, the only durable position in this market is the one that cannot be margin called out of existence. I want you to imagine something. Imagine you are sitting in a room full of people who all bought silver in November 2025. Half of them bought physical silver or unleveraged ETFs. Half of them bought leveraged futures contracts. Both groups understood the thesis. Both groups were right about the direction. When January arrived and the margin calls came, one group sat quietly and waited. The other group was forced to sell at $64, lock in the maximum loss, and watch silver recover to $86 without them. The metal was real. The supply deficit was real. The structural case was real. The only thing that determined who benefited and who was destroyed was whether they owned the physical reality or the paper promise. I have spent 40 years watching investors confuse the two. The door to the physical silver market is open. It has always been open. The truth has always been in the warehouse receipts, the lease rates, the Shanghai premiums, the mine offtake deals, not in the narrative being sold by people who profit from keeping you in leveraged paper. Own the reality, not the promise. That is the uncomfortable truth they do not want you to understand, because understanding it makes you impossible to margin call. That is all. Thanks for watching.